Investing in the stock market can be a great way to grow your wealth over time, but it's important to approach it with proper research, a solid understanding of tax implications, a budget for your investments, and the patience to see your investments through the ups and downs of the market. As a beginner, it's essential to do your research and educate yourselves on the basics of stock market investing. This includes understanding the different types of stocks, the risks and potential returns, and how to read financial statements. In this video, we will go through the basics of investing so you get an idea of how it normally works.
Number 1. Research and understand the stock market. Investing in the stock market can be incredibly successful and rewarding experience, but it is important to understand the basics before diving into it. As a beginner, research is key. Learn as much as possible about how the stock market works, what stocks are most viable for long-term investing, and how automated investing services can help you get started on the right path. While some concepts may seem complex at first, continue exploring until you have a basic understanding of how the stock market operates. This knowledge will provide invaluable early insight into your investing journey and set you up for success. Number 2. Set a budget for investing in stocks. It is important to create a budget before you get started. This approach will not only help guide your decision-making process, but also ensure that you stick to investments within your price range and limit risk-taking behavior that could be detrimental to your future financial goals. Setting a budget often involves understanding your current financial situation, so you know how much money is available for investing, as well as tracking all of your purchases regularly to make sure you don't risk overstretching yourself. With this approach, investment in the stock market can become a healthy habit rather than something just too overwhelming or risky to consider. Number 3. Choose an online broker or financial advisor. Choosing an online broker to invest in the stock market can be a daunting task, especially for beginner investors. There are many factors to consider, such as the trading fees, customer support, and quality of tools available for research and analysis. It is important to compare brokers before selecting one that is right for your specific investment needs, whether you're an occasional trader or long-term investor. When choosing an online broker, make sure they provide fast and reliable execution of trades as well as low-cost overall trading costs. Look out also for comprehensive customer service and support, which should always be available to answer your questions and provide reliable advice when needed. Ultimately, ensure they have a good reputation and satisfied customers so you can rest assured that your investments are in safe hands. Number 4. Decide on which stocks to invest in. Deciding which stocks to invest in as a beginner investor can be a daunting task. Nevertheless, it can be managed with patience and research. It is essential to have a solid strategy by understanding the basics of stock investing, such as risk management, diversification, and fundamental analysis. Additionally, having good knowledge about the company you're considering investing in is crucial for successful stock choosing. Start with reading the financial reports that outline their financial standing and check consumer feedback regarding their products or services. Lastly, other important factors to consider when selecting stocks to invest in could include dividend payments, target price history, and trading volume. With the right amount of planning and careful consideration of your options when selecting stocks, you will be well on your way to being an informed investor who makes wise decisions. Number 5. Learn about different types of orders, such as limit orders and stop-loss orders. Understanding different types of orders will be beneficial when starting, as the jargon can be confusing. Limit orders allow an investor to buy or sell an asset at a certain predetermined price, while stop-loss orders are aimed at reducing potential losses if the market moves against them by specifying a price at which the trade will be automatically closed out. Knowing how to put both limit and stop-loss orders into action properly is critical for protecting your capital and achieving long-term success when investing in the stock market. Number 6. Monitor your investments regularly and make adjustments when necessary. Being aware of the current market conditions and trends gives you the insight you need to determine when changes may be needed, such as buying or selling positions. The key to successful monitoring is having an open mind and being willing to adjust if any positions are not performing as expected. To achieve this, you should have a clear understanding of your financial goals, risk tolerance, and time horizon for holding investments so that you can compare how your holdings align with these objectives over time. Regularly reviewing portfolio performance helps ensure that any necessary adjustments are made in order to reach long-term investment goals.
Number 7. Diversify your portfolio by investing in multiple stocks from different industries. Investing in multiple stocks from different industries is a great way to grow your portfolios and reduce the risk of losses. Because stock prices can change drastically based on factors pertinent to that industry, it is wise to spread out investments across multiple industries to diversify the portfolio. That way, even if specific stocks suffer a large loss due to poor performance in their industry, investments in other industries could help balance out any losses. Putting investments into different sectors will provide better protection against risks, helping you avoid potentially significant losses. Diversifying a portfolio with multiple stocks from different sectors is an effective strategy for anyone just starting out investing.
Number 8. Understand taxes related to stock investments and plan accordingly. One final thing to note: having some background knowledge on the various tax strategies, such as how long-term capital gains are taxed, or the difference between dividend income and ordinary income, is useful when filing regular returns and during off-seasons of trading. Additionally, having a grasp on the basics of taxations associated with stock investments provides you with further advice that you may otherwise not know you possess. Not only is such knowledge helpful in planning future financial advancements, it also allows you to better plan your budget for current investments and protect against taxes which may be unnecessarily high if certain steps are overlooked or forgotten. Understanding taxes related to stock investing will improve your portfolios over time. Taking the time to receive help from certified advisors or diving into research is highly recommended before deciding to invest any funds. Finally, investing in the stock market requires patience. The stock market can be volatile, and it's important to have a long-term perspective and not to make any impulse decisions based on short-term market fluctuations. With proper research, budgeting, and a solid understanding of tax implications and also patience, you will be well on your way to successful stock market investing.
If you found this video useful, please share it with your friends. Give it a like, subscribe to the channel for more stuff like this, and leave a comment as to what video you would like me to do next. Bye bye!